Hello there, my dividend growth stock investing pals out there. It's Colby, the DGI crab, and I wanted to show you all the power of the dividend snowball. There's some YouTube videos out there on the dividend snowball, but you know what? I want to bring you all the meat. All right? Really want to get into some good raw data here on a spreadsheet, show you the power of dividend growth stock investing and just how much passive income that can generate you over time. How you can retire off of that income and not have to be stressed out about selling shares of stocks or be overly concerned about massive dividend cuts to your portfolio and maybe having to go back to work when you didn't want to, when you thought you were retired from the rat race. All right. So I'm not bringing you stock footage of charts and graphs or any more of that guy at the calculator in his computer really crunching those numbers and looking stressed. Not doing that, y'all. Maybe it's not flashy, but I respect you enough to know that you're going to be paying attention to this video, this spreadsheet, as I walk you through it, because the dividend snowball is really powerful. And if you're really paying attention and you follow me along here, you're not going to need all those fancy visuals, okay? The numbers should be exciting enough on their own. So what are we looking at here? What the heck have I done? What are all these freaking numbers here? Okay, so we're going to start out here. We're going to take the age of the investor starting out. I'm going to assume a contribution to a brokerage, non-retirement brokerage account for the purposes of early retirement off of dividends with $100 a week worth of a contribution, or we'll just call that $5,000 a year. DGI crowd, how am I supposed to come up with an extra $100 a week? Well, I don't know. You could donate blood plasma twice a week and get $100. Come on now, guys. You could go drive Uber for like 3 hours in most cities and make $100. There's, figure out a way to come up with $100 a week and invest it. All right. I'm not giving you investment advice, but let's just say that this is from an unlicensed professional. I just think that, if your excuse is I can't come up with $100 a week, that's pretty weak. You can figure it out. All right. It's not that tough. And when we go through this, I'm hoping that a lot of y'all be motivated to come up with that extra income so you can start squirreling it away to generate some real passive income. All right. So we're going to assume, and you can take 2 weeks off every year. All right. 52 weeks out of the year should be 5,200. I just rounded out 5,000. Okay. Take the week off on your birthday and on Christmas. Okay. And and don't worry about it. So let's say that our 20-year-old investor is doing the kind of thing that I think is smart. All right. They're buying lower yielding stocks with really high dividend growth rates. Okay. So we're talking about starting yield average of about 1.5%. Not too exciting. It just means in that first year, their $5,000 acquires about $75 in forward annual dividend income. Wah, wah, wah. Okay, bear with me. Okay, just bear with me a little bit. All right. I'm going to assume that because they're buying the low yield, high growth stuff, that their dividend yield cumulatively is going to grow by about 12.5%. Okay. And then share price appreciation. Guys, this is a tough one to figure out. I'm going to assume 10%. Okay. S&P 500, the average share price return year over year is 11%. Obviously, share price appreciation is one of the toughest things to predict. So I'm not going to get too hung up on this column, but let's just assume 10%. Maybe some years it's better, some years it's worse, but just go with me on this one, okay? So what do we got here? We've got a $75 of income that was acquired through the contributions, okay? Dividend growth of 12.5%, so $9 and some change, which means at the end of year one, we're hoping that we've got a portfolio yield of around $84.38, give or take. Okay, fair enough. So then year two at age 21, we're going to contribute another $5,000 over the course of that year. We're going to have our dividend yield here is going to be what we've acquired at about 1.5%. And then plus we're adding in the dividend reinvestment of this $84. And then we're getting another 12.5% dividend growth at the end of year 2. We're up to $180. And we're going to keep doing that. Same strategy all throughout the 20s, 22, 23, 24, just doing $100 a week, taking your birthday and Christmas off. All right. $5,000 a year. And we're acquiring every single year. We're just going to be acquiring dividend yield starting average of about 1.5%, reinvesting all of the dividends that we've accumulated along the way, and getting a 12.5% dividend raise year over year. And by the time you get down to age 30, which is the final year of tier 1, which to me that's the first category of age in my channel, 18 to 30, tier 1, low yield, high growth. By the time we've gotten done with year 30, we've invested $55,000. Our portfolio is yielding $1,964 a year. Not super exciting even at that point, you guys. But if you want to build a house of bricks for your retirement, you got to do it slow and steady and correct with blue chips, high dividend growth. Now, age 31 to 42, I call that the tier 2 investors. Tier 2 investors are going to start acquiring, stocks and ETFs, not necessarily in the 1% range anymore. They're now looking at more of that 2.5–3% starting yield. Maybe the overall dividend growth rate slows down a little bit at that point. They're looking more for like 8–9% year-over-year dividend growth. But what they've got so far is this pile of stocks yielding almost $2,000 that still should continue to increase by 12 to 14% year over year. They're just going to set them off to the side, let the dividends reinvest in those, and they're going to use their $5,000 a year moving forward to acquire the 2 to 3% yield stuff. Okay. So as I've kind of worked my way down through here, I slightly adjust the formula a little here and there just to account for maybe the dividend growth rate starting to slow down just a little because we're adding some slower growth rate stuff, and the initial starting yield going up a little bit more because we're acquiring higher yield stuff to begin with. Hopefully you're following me. We get to age 42, the final year of the tier 2 investor, and now all of a sudden we're getting $13,455, give or take, of annual forward dividend income. How much have we invested of our own money at that point to get there? $115,000, okay? Our yield on cost is over 11%, pushing 12% already. The dividend yield is nearly 12% year over year, the amount of capital that we've invested up to this point, even though we have only been acquiring to this point stocks yielding in the 1s or the 2s or maybe in the low 3s. Once you get into tier 3, the age 43 to 54-year-old investor, we're acquiring a bit higher starting yield now. We're looking for stuff that's going to yield us at least 3%, but hopefully in the high 3s, maybe in the low 4s. Our dividend growth rate on the stuff we acquire is probably going to slow down a little bit more there. Now we're looking at maybe 5 to 7% annual dividend growth rate, but we've still got that initial pile of stocks from our 20s and that yield that's growing at 12 to 14% a year, in essence doubling every 5 years. And now we've got a pile of stocks from 31 to 42 where we've got a 8 to 10% dividend growth rate. So now we're acquiring a little bit higher yield. We're kind of moving through there, getting close to retirement. We get all the way up to age 53, the final year of the age or the tier 3 age range. And now we've got a portfolio yielding just shy of $50,000 a year. Totally passive income of $50,000 a year. We have invested to this point $170,000 of our own money, and $50,000 in totally passive new money is being reinvested automatically into that portfolio year over year for a yield on cost of 29%. Are you kidding me? Now, I know that you can cut corners with this. There's a lot of really high yield covered call related crap out there where you can jump right in and start yielding $50,000 a year on $75,000, $100,000 worth of an initial investment. Guess what's going to happen with most all of that stuff? The share price appreciation is going to go into the gutter. It's going to tank. And the dividend yield, when that happens, is going to get cut, or there will be reverse stock splits. There's going to be a lot of things that impact how much passive income you're getting. This number here should continue to grow whether you're reinvesting dividends or not at this point, because I don't recommend on this channel you buy anything that doesn't have a long track record of increasing the dividend. That's why I narrowed the channel down to just 60 dividend growth stocks, split them into these tiers that are most appropriate for your age range, and set it up that way. So that way you're not going to have to worry about dividend cuts. Maybe one of the stocks will cut its dividend eventually. So what? By this point, you've probably owned about 30, 35 of them, and it's not going to be that big of a deal because all the other ones will continue to increase theirs. Now at 54 and up, you're going to just start adding stuff a lot higher yield, slower growth at this point to really kind of help push you over the edge. You're looking for that 6, 7% yield, slower growth, but just good, steady, slow growth. And by the time you get to age 59, now you've got $91,000 of forward dividend income. And you've never increased the amount of money that you've been contributing. Just $100 a week. That's it. Just $100 a week. You have contributed from age 20 to age 59, $100 a week, $200,000 over the course of a working lifetime put into this portfolio, and the thing's yielding $91,000 a year, or a 45% yield on cost, year in and year out. That's some powerful stuff, you guys. Now listen, it's great, all of this stuff. The younger you start, the better. Because if you start with this at age 31 with $100 a week, all things being equal, and you don't get any of the really high growth stuff, you just start with that 2.5% yield, 8 to 10% annual growth, and just go through the tiers that way. By the time you get down to age 59, you still got a nice portfolio here yielding $31,000 on just $145,000 invested. 22% yield on cost, still a nice place to be in. But if you get a later start, you guys, it just means you're probably going to have to push a little harder, invest more than $100 a week. Maybe you got to do $150 a week at this point to get the kind of numbers that we saw up above, or $200 a week. But the whole point of this is that the longer that you go, you are going to start yielding so much more money than you're actually contributing to it with your active income. You've got a part-time worker just sitting there running their butt off for you and generating you a bunch of money without you lifting a finger. And if you get that start really early, you've got a full-time master's degree level person here working full-time for you, giving you pretty much their whole salary, and you're not doing anything for it. I know that it takes a while to build up this kind of yield. It does take hard work to do it this way, but if you do it the right way, you've got a house of bricks. You don't have to worry when you reach that point of financial freedom where you're bringing in enough money with the dividends alone that you don't have to worry about working anymore. You really can stop at that point. You really can. Because like I said, maybe you've got 40 positions and one of them eventually cuts their dividend. Oh well. Sell out of that stock and move it into something else. Not a huge deal. Your overall portfolio dividend yield should continue to go up. So I'm going to leave links in the description below to a video on each of the 4 tiers, explaining all the stocks that I have at each of the tiers, why they're there, and why I think they're the most appropriate for that age, as well as the ETF video with a very similar strategy. All right? So I didn't throw a lot of flashy stuff at you guys. We're just looking at a spreadsheet here, but I hope that you can get excited about a number like this, $91,000 a year of passive dividend income that's not going to go down. I love it. I think you guys should too. Till next time, everyone, this is Colby the DGI Crab.